Now getting into we're getting here into the term number 10, accounts receivable. This is an account used to track all the customer sales that are made using store credit. This does not refer to credit card style credit. This refers to the actual businesses that allow the customer to have credit so that the customer can provide payment at a later date. What does that mean?
Well, it just means you're providing a good or service and you're not getting paid for it. You are extending credit to your customer, expecting to be paid for it within a reasonable period of time. It's very common in certain types of business. Of course, the rule of thumb is if you can get your money, get it now, rather than carry accounts receivable, because the pitfall of carrying accounts receivable is even though it's a valid asset, if it requires capital.
Yeah.
So the bigger your accounts receivable, the more capital you've got to have in your business to continue paying your bills when they come due.
This almost wiped me out when I first started in business because I was doing a lot of business for school proms. I was providing entertainment services for schools. And those guys like to pay like net 30, net 60. I guess when I say net, that means that they're not going to pay me what they owe me for 60 days or 30 days. And I had to pay my staff and pay for my team and pay my lease and pay my ads. And I thought, well, as soon as I DJ for that prom or provide entertainment service, they'll pay me. And that was not the case. And so this was a very big
very
thing.
Deceiving.
It was bad. It was bad. So please learn from my errors there. Just make sure you're budgeting out and don't count your accounts receivable as cash in hand until you actually have it there.
That's good, yes.
Now, term number 11, accounts payable. This is the account that is used to track all the unpaid bills from vendors, consultants, companies, and individuals from whom the company buys goods or services. Talk to me about accounts payable. What does that mean? Why do I need to care about it?
It's a legal liability. Accounts payable are a legal liability, so you must plan on paying it or having someone probably take you to court to collect it. So it's a legally enforceable obligation. And so therefore it should be important to you. You've incurred a legal liability to pay someone, generally within a stated time.
Yeah.
And so you should have the ability to fulfill that obligation. And the typical mistake that most entrepreneurs make is not keeping track of the total liabilities they're incurring. They're maybe piling up unopened on the desk rather than being opened, processed through the accounting system and appearing on that monthly balance sheet so that you know what kind of liability you're building. That may change your thought process on whether you can buy the new piece of equipment or that type of thing with the utilization of your cash.
So if you're an entrepreneur watching this and you're kind of the I don't like to open mail guy, where you typically don't look at the mail, you typically don't deal with bills promptly, this is for you. Open those bills, process those, run them through the system, and that'll affect your spending habits moving forward.
Absolutely.
Now we're moving on to depreciation. This was a term that I never understood at all until about 4 years into business. And it says it's in reference to the accounting method that is used to track the use of assets and their aging. Every asset a business has ages and will eventually need to be replaced, including equipment, electronics, buildings, etc. Talk to me about depreciation and why we need to chart this stuff.
Well, you sure opened up a topic of conversation on that one, Clay. There's a lot of confusion about depreciation that's allowable for income tax purposes versus realistic depreciation that truly reflects the economic life of any given asset. The Internal Revenue Code has been very liberal in recent years, allowing entrepreneurs to write off assets the very first year that they purchase them, which may be good. We recommend that in a lot of cases simply to lower the tax liability.
Yeah.
But the pitfall that most entrepreneurs make in this area is they record that same aggressive, very rapid write-off depreciation used for income tax purposes. They use that for their financial statements. And so that becoming an expense, it lowers equity. And when you go into your banker to make a loan to buy that new piece of equipment, he looks at it and says, well, you have no equity.
Let's assume that I'm a third grader and I'm from a different planet, or at least maybe a different country, and I kind of sort of understand English. So walk me through this, because you threw out a lot of terminology there that I think maybe some of the thrivers might not get there. So you're saying that the depreciation, the government allows me to be liberal with it. I mean, I can, if let's say I bought a printer for $1,000, the government lets me write all of that off my taxes up front sometimes?
That's correct.
Okay, so I write the whole thing off, and so I said I bought it for $1,000. When it comes time to pay taxes, let's say I owed $10,000 in taxes, I can say, well, I spent $1,000 on my printer and reduce my taxes a little bit.
That's correct.
Now, where do we make the wrong turn now?
The wrong turn is on the balance sheet and profit and loss that's maintained and provided to bankers, bonding companies, whatever the case might be, is you would want to assign the true economic life to that printer. Let's say that printer will last 10 years. Then your depreciation each year would be $100. So that in your financial statement, you're showing depreciation expense this year of $100, which therefore you show a greater profit than you're showing on your tax return, where you're showing depreciation for $1,000, the entire cost of the printer.
Okay, so what would be, if you are an entrepreneur, do you recommend that an entrepreneur tries to do their own depreciation schedules, or do you recommend they have an accountant to help them with this?
I would categorically say they should let an accountant handle that.
If you're watching this and you're going, no, I want to do my own depreciation. I love depreciation so much. It's just something I want to do. We strongly recommend that you do not do this.